Today, we will look at a way to make even more dividends on the same capital. Holy banana bread, let's do this. Most of us really love our passive income in the form of dividends. So what if I told you there is a way to capture even more dividends to enhance some passive income? In fact, I am going to show you in this video exactly how to do it, and as a bonus at the end of the video, I'm going to drop a tool you can use to help you find ex-dividend dates. If you are new and don't know what an ex-dividend date is, don't worry. We got you covered. Before we capture those dividends, let me know in the comments if you are new to the channel. Welcome aboard. I am very grateful to see you all here in the home of free financial content on YouTube. Be sure to subscribe right now so you won't miss a single moment, and a huge thank you for that click. It is important to understand how dividends work for this strategy I am going to cover today. Thus, we will take a moment and drop a few of those dividend basics to make sure we're all up to speed. For those totally brand new to dividends, a dividend is essentially just a payment from a company to thank you for your investment. It can be thought of as your portion of the profits. Of course, not all companies have dividends, as some growth companies like to reinvest their profits into their own growth. There are also different types of payments, from dividends to derivatives, but for the sake of this strategy, they are not important. The next important concept to understand is the life cycle of a dividend. A dividend begins with a declaration date, which is the date that the company's board approves and announces that dividend. They will also announce the amount of the dividend as well as the record and payment dates. We will get to those two dates in a moment. The next big date is the ex-dividend date, which is not declared by the company, but rather by the exchange it trades on. This date is technically the first day the stock trades without the dividend included. In other words, the exchange prices in the loss in market cap that the company experiences because of the dividend payments. This date typically can occur from 1 to 3 days before the record date. The next date of importance is that date of record, and that is the day an investor must be on the books to receive the dividend. This is huge because if you miss this date, you are not going to receive any dividends. We will break this down in a moment, as it is key to dividend capture. The final date is the payment date, which is when the company pays out the dividend to your broker. In most cases, you then receive that dividend the next day. When you purchase a security, it does not instantly get updated with your name, as there is a settlement period. Most stocks in North America take 2 to 3 business days to settle, which means you need to buy your stocks at least 2 to 3 days before the day of record to get that dividend. Holy banana bread, that does sound a little complicated. Luckily, it is not that bad. As you remember, the ex-dividend date occurs before the date of record, and in almost all cases is that guidepost you can use to make sure your name is on that dividend payout. To make sure the dividends are yours, you want to buy the stocks the day before or even earlier of the ex-dividend date, and you want to hold them past the opening on the ex-dividend date. If you remember, I said that the market cap lowers slightly to account for the dividends. As you can see, that ex-dividend date is pretty important, and that is the reason that the exchanges have it before the day of record, because they're trying to set that date up as that guidepost for you so you know whether or not those dividends are going to be yours. If you remember, I said that the market cap lowers slightly to account for the dividends going out. Thus, the price will also generally drop. This is important, as you will need to hold those stocks until the price rebounds into profitability. This is usually not a problem in a bull market, but in a bear market, you need to be more cautious. If you try to perform a dividend capture on a stock that historically takes longer to recover, you may have to hold that stock much longer than you would like to. So, when it comes to dividend capture, you want to be researching your targets, and I mean big time researching. Look back at previous ex-dividend dates and see how that stock behaves. If it drops and takes a week to recover, this is not the stock to pick. If it traditionally recovers later in the day on the ex-dividend date, this is a much better choice. If we were to use channel favorite Canoe EIT as an example, the next ex-dividend date is November 21st, and their previous ones were October 20th and September 21st. If you bought in on October 19th, you more than likely would have paid around $12.70 per share. On the next day, the ex-dividend date, the share dropped to $12.58 at opening. If you sold right away, you would overall be losing 2 cents per share. That's basically the difference minus the 10-cent dividend. It recovered in the morning, getting up to $12.68, and if you sold then, you would be receiving 8 cents per share. In that case, I probably would sell, as that then allows me to move to the next target. However, when we go back one more month, EIT was coming out of a peak at $12.97 and then fell to $12.72 on the ex-dividend day. In this case, it is a loss as the price still has not returned to that peak. That example illustrates that you need to not only look at the trend for how long a stock typically takes to recover, but you also need to look at the overall trend. A stock that looks to be peaking or could be about to crest is much, much riskier and not always a good target. Always zoom out to the big picture before you act, as it can save you some serious heartache. If we step back for a moment, I do want to also talk a wee bit about where this should be done, as it is absolutely not something you want to be doing in a registered account. Too much buying and selling in a registered account can get you flagged by the CRA for some further scrutiny. Buying and selling too fast is a business behavior and is not the intention of the TFSA. Trust me, getting audited by the CRA is never a fun experience, and the end result may be that you're paying some taxes on those business gains and losses. A personal or cash account is ideal for dividend capture if you plan to really pull in as much dividends as you can. Just keep in mind that you will be paying taxes on the dividends and potentially any gains you make on the money you make while you're flipping those securities. When it comes to setting up your dividend capture strategy, I will look to choose my targets from higher yields simply because I get more wiggle room on my exit. I do like my wiggle room. So that first burning question that I think many of you have is, how do I find these stocks? Well, the answer to that is that I use that tool I mentioned at the top of the show. I use a fantastic little website over at tsx.xdividend.ca. This site gives you lots of ways to search for your dividends. I typically search by yield, as I do not typically like to touch yields under 6%. Once I have my results, I sort by ex-dividend date, and then I look to see the potential targets, which I will then research. Some other potential things to look at which can cause you problems is low volume stocks. You want to stay away from those low volume targets as they can take longer to recover and can also be a pain to sell if you are working with higher capital. Also, when it comes to selling, do use a limit sell order, as that will make it much easier to nab an exit point if it pumps while you're off doing something else. One other little consideration is to try and avoid stocks with large bid-ask spreads, as they can turn a profit into a loss if you do not look at the bid price, which is the amount you will get when you sell. And it can sometimes be significantly lower than the listed share price. How much can you make doing this? That really depends on the market, as you will do better in a bull market. It also depends on the amount of research you put into your targets. And of course, it also depends on how much capital you are using. You can make some great dividends, but as anything else on the market, you can lose money too. This is a moderate to high risk strategy, and you should not be just dumping money into it if you are not prepared to lose that money. Always do your due diligence. And it is never a bad idea to consult a professional, such as, well, a financial advisor. The fun does not have to end here, as you should check out my video on bear market investing that I have linked on the left, or you can check out the video YouTube thinks you will like on the right. Your click will decide who is right, and I will see you in the next video.